What's going on? This is Cool and Black. Welcome to Fibonacci 2.0. Just like a little update from my previous Fibonacci video, drawing Fibonacci. And this video right here is just like a little, it's a bit more complex, it's a bit more advanced. I do trade at an advanced level. And I'm going to show you guys the ins and outs on how I use Fibonacci. Keep in mind, there's many ways on how to use Fibonacci, but the way how I see it, a lot of people don't personally, but at the end of the day, like, remember, this right here is very subjective, and it's all about precision. Where you actually draw your point A and your point B's on your Fibonacci, those all matter, to actually measure the retraces that you're actually gonna get off of these Fibonacci levels. Okay, so first things first, I want you guys to take a screenshot of this right here. And these are the main points that I do use on my Fibonacci. All the ones that are checked off are the relevant ones. Okay. These ones are red. The 1.2 and 1.1 are red because these are preset stop loss areas that, if I'm measuring based off structure at the end of the day, which is what you're supposed to be trading off of, your stop loss areas are either 110 or 120% based off your Fibonacci, which gives you either above the previous high or below the previous low, which is your stop loss areas. And these are at those points because at the end of the day, like if it does, go at the 110% or 120%, you shouldn't even be in your order in the first place. An example of this right here would be something like this right here. So let's say if I was measuring my Fibonacci from here to here, okay, point A. I'm gonna go more in depth later on, but I'm trying to give you like guys like a basic concept of how I actually use the 110 and 120%. So this right here was a level of support which was broken somewhere over here. Right here, and it's based off of these points right here. But this is exactly where the market found a level of support, which it was on uptrend before, and it found a level of support here because you see a bearish candle, then that bullish candle, which confirmed that area was a level of support. So yeah, so I put my random line right here. Let me put it as blue. That's my random line, so that's going to be an area of support. As you can see right here was the tested candle. These two tested, 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 tested. So that's my area of support, which means that's where my previous high is going to be also. Keep in mind, you could also use a trend line area somewhere over here. That could have been used as a trend line area. And I'm marking my previous high because this right here is a lower high. And when I'm drawing my Fibonacci, when I'm drawing it on a downtrend, your point A is going to be based off of the top portion of a bearish candle. And then your point B is going to be based off of the bottom portion of a bearish candle. So right when the market found that level of support, it's going to be based off of that bottom wick of the bearish candle. So it's bearish to bearish, and bullish to bullish on uptrend. Okay, so this example right here was for the stop loss areas. Okay, put on my drawing tool. So the market went like this. It came down to that level of support where it found right here. Then it came back up to your your 23.6%, which is not considered as a PRZ level, but it's considered as more of an area for continuation because the market never made a significant retrace, which can affect the market in a crazy ass way. Consider it kind of like a speed bump, right? So consider the 23.6 like a small speed bump, which can't really affect the speed of a car, and the car is going to keep on going, in full motion. Compared to you having a bigger speed bump, which is like a 38.2 or a 61.8, that's going to affect the car's speed, which is going to slow it down in some kind of way. Okay, like it's like I'm all about analogies, so I hope you guys understood that example right there. So this right here, it came up to 23.6. So I put it at 110 and 120% because at the end of the day, like if you actually came back up and broke this area right here, which is gonna be breaking support, I mean breaking resistance, structure is gonna be broken. So you wouldn't want to be in your trade in the first place if structure was broken, because now you're going the opposite direction. So if you got in a sell, you know, somewhere in this area, which means that you could have gotten on a sell at 23.6. At 23.6, you could have gotten on a sell at 38.2. You could have gotten on a sell at 50%, 61.8, 78.6, 88.6, and the max retrace, which is going to be 100%. Okay, so the market itself can retrace anywhere in these areas right here, because those are all price reversal zones. I mean, those are mainly price reversal zones, which is at 38.2, 61.8, 78.6, and 88.6%. 23.6, 50%, and 100% is not considered as a price reversal zone because the market is unbalanced if it goes inside those areas right there. So whenever the market does do a full retrace, which is just considered as a retest, it's going to be at the 100%. So if the market breaks the 100%, then now you're in the completely wrong direction, which is when you don't want to be inside your trading in the first place. Okay, so that gives you a little bit of breathing room at the end of the day to actually know that, you know, that's like your safety net if market does completely go out of your favor, and then, you know, it screws you over big time. So like that's like a safety net that I use 110% and 120%, you know, just so you don't actually stay in the wrong direction. Okay. And there's going to be smaller moves when you actually can take advantage of this a lot better. But 23.6 are like the most dangerous areas, mainly because if you got an on order at 23.6, you have all this fuck up room right here, all right? Because the market, it could have retraced anywhere in between here and been a lot safer, but 23.6 is that lowest point, which means that you have to be real careful if you're trying to get on a sell on 23.6, because it could easily, you know, shoot up and go to 38.2, 61.8%, 70.6, 88.6, you know, and then you gotta manage your account. That's where risk management comes into play. So if you got on an order based off of 88.6%, which is that, you know, like the closest point to the full retest of the entire market, you're not taking that much risk on your account, because if you got an on order right here, your fuck up room is small. You know what I'm saying? Compared to 23.6, it's huge. So you got to be real careful on when you take an order at 23.6, because it's more based off of a continuation type of move in the market, because the market itself, it's majority still sellers. Right here is buyers. You know, who's in control? Sellers still. Okay? So you wouldn't want to actually just jump right in unless you have full confirmation that the market is ready to actually push. Okay? So whenever I'm drawing my Fibonacci, I normally draw it based off of the same time frame that I'm actually going to be doing my structure on, which is going to be either the 4-hour chart or even a daily chart, you know, so on and so on. So you always want to just stick to those time frames that you're analyzing on, so you could pretty much do your fibs on also, because that's when I'm actually measuring the main retraces of this entire move. So for example, if I wanted to actually break this entire chart down right here, okay, I have my point A and my point B based off of you know, this level of support. Some people might say, oh, so why didn't you put the point B somewhere over here? That is all based off news. That happened after the fact that the market found a level of support in this area right here. Okay, so the market itself, it consolidated for a certain amount of time throughout these areas. Found a level of support right here. A level of support right here. Okay, right at 23.6. So when a market does actually form a 23.6, or it's respecting a 23.6, the main thing that you're looking for based off Fibonacci is that you're looking for a lot of consolidation within this area right here, right? It's going to be consolidating within 23.6 up until it has a a bearish move to actually tell you that, you know, sellers are in control and you're ready to actually start pushing down and continuing the downtrend that you're currently in. Seeing that structure was already broken over here, okay? So around this area right here, the only time that you actually seen a selling opportunities anywhere around here is when the market actually formed this little bearish candle right here, which closed below this bullish candle right here, which says that that's a bearish variation, which is what I talk about in my recent webinars and in my 5-day course also. So that says that, you know, sellers are in the market, and that's when you can actually start looking for sells upon this move all right here. Okay. So that's when you know that 23.6 is a valid sell opportunity. But besides that, if the market is not making any kind of bearish type moves or bearish variations, then you're not ready for a seller's type market yet, because it can consolidate for a longer period of time. Right here, it had a bearish candle, yes, but it did not close below this area right here, which was that level of support for that bearish candle, which was that bearish opening. Like how it happened right here. This was a doji. Like I said, ignore the doji, put this and this together. That's a bearish engulfing pattern, which says that sellers are in the market, which is going to be continuing that bearish move. Okay. So when the market does actually find that level of newfound support, you know, below that point of support, which was right here. This right here was the previous support. Or right here is the level of support for this area right here. As you can see, this right here was tested. So if I'm measuring this retrace, once the market finds a level of support, which means that it forms a bearish candle, but then the candle after that, it forms a bullish candle, which says that area was established as a support for this time frame. Okay. If I wanted to measure this move right here, I measure from the highest point from the previous high, which is going to be somewhere around this area. So like I said, the top of a bearish candle is going to be this top wick right here. So this right here started pretty much the bearish move for this push. Point A. Point B is going to be based off of the bottom wick. 1 second. Point B is going to be based off of the bottom wick on this candle right here, this bearish candle, the bottom wick. And once again, you're measuring the retrace. Okay. When the market is actually retracing back up, you can actually go on lower time frames to actually see how the market is actually acting along these areas right here. Okay. So if I'm basing my structure off of the 4-hour chart, that means my structure is based off the 4-hour time frame, which means that any time frame below that is going to be showing an excess amount of candles, which is going to give me, you know, excess candles, which kind of throws the person off because they think, oh, hold on, but look, it went to 38.2. It went to 38.2 on the hour chart, but I'm not basing my structure off the hour chart, so it's invalid in the sense that I'm basing my structure off the 4-hour time frame. So as you can see, based off the 4-hour time frame, the market didn't actually close at that 38.2 mark, which means that that area of resistance that it did establish was at that 23.6, which means what? More of a continuation than a major reversal. Okay, so you're still looking for bearish moves as well. Same concept here. Along this consolidation area, you're always looking for consolidation around that 23.6 area. Consolidates, tested area, tested candle. Right here, tested candle. Okay, 23.6. Bearish move. This candle right here is bearish. As you can see, it formed that level, that bearish candle, but the candle after it, it formed like a nice, like a bearish move that says that, sellers are inside the market for this type of setup right here. So to even confirm that, also, you could have been on the 4-hour time frame to see when the market actually found that level of that new level that it actually broke support, which was based off this candle. This was the top area, which was at that 23.6 based off of the 4-hour time frame. But on the hour time frame, you see an excess amount of candles, which you could actually, pinpoint where the market is actually going to be finding that level that says that sellers are inside the market for this portion of the market. Okay, so the whole entire time that you're in this whole entire zone, this right here, it could have been a sell setup. Yes, it could have. that could have definitely been valid. But see like how it didn't push past that area. So this area of support was still valid up until the market actually broke this area of support. Okay, so this candle right here was definitely that candle that says that the market had enough sellers inside the market to actually keep on pushing and keep on continuing the trend that it was currently in. Okay, so the steeper the retrace, the slower the overall move itself. And I'm gonna give you some arrows, some more examples. Okay, so let me line it up real quick. So this area right here, this right here is a 23.6 move. This area is a 23.6 move. Very drastic also. Similar to a 38.2, but 38.2 is an actual PRZ level. It's 38.2, you're looking for a very aggressive push. Remember, 23.6, you're always looking for a continuation, which you could actually find consolidation at 23.6. 38.2, that's the actual price reversal zone. Okay? Okay, so next is going to be, I don't really pay attention to that 50% too much, because at 50%, everything's even. So you don't really know like what it can do as far as what it's expected to do, because 50% market's even. It's even. It's 50% buyers and 50% sellers, which says that, it's major indecision overall. 61.8. Damn, this just sucks. 61.8%. You're looking for, not really that aggressive, but you're looking for a nice moderate push, which then it actually breaks that previous low to continue to move. 78.6%. You're seeing it's always a trend. Within a trend, the higher the retrace goes. Okay, that's 78.6. And 88.6, which is the max PRZ level, you're seeing a very slow push. So you're seeing trends within trends when it comes to the market actually retracing very, very steeply along the areas of Fibonacci. Okay? So this right here, this area right here was broken on this level of support. So this area. Okay, so point A is going to be based off of the previous top wick of a bearish candle, point A. Point B is when the market actually finds that level of support, which I told you before, bearish candle, bullish candle. That says that market has found a level of support, okay? Okay, so along this entire area right here, you're seeing a bit amount of consolidation, but the market itself, it found a level of resistance at that 38.2 mark. So once the market actually hits that level of resistance based off 38.2 on a 4-hour time frame, remember 4-hour time. This is the 4-hour time frame 38.2. Okay, so once the market actually even established that, break it down on lower time frames, seeing what the market is doing on these time frames to even get in on a nice sell type setup. Okay, so the best type setup that I seen was at the first 38.2 touch at that 4-hour time frame, which was somewhere over here. Okay, so the best selling opportunity is when the market had enough sellers inside the market to actually even push. Okay, so as you can see, bearish engulfing pattern, close that. That could have been your selling opportunity right there to actually hold it. Okay, so if you're taking your structure off the 4-hour time frame and the 4-hour Fibonacci, this is 38.2 based off of what? The 4-hour time frame, right? So you getting in on a 1-hour market structure type setup, you always have to keep in mind that you're basing off of the 4-hour time frame. So it could possibly take a lot longer to push, because remember, you're pushing off of the 4-hour. You're not pushing off the 1 hour anymore. Okay? Your setup is based off right here, meaning your entry was somewhere over here. Okay? That's your entry based off the setup of the 1 hour time frame, but your structure based off the 4-hour time frame. Okay? If you wanted to actually break this down to the 30-minute time frame, which is your entry time frames, you could have definitely seen, a lot more precision, because you're basing your structure off of these time frames now. You can actually break this down and see where structure is broken on these time frames to give you an established area. Okay, this right here was the higher high point, the higher low point actually, which was broken on that level of support. This right here was that newfound support. This right here is that new lower high point after the broken support, which gives you a seller opportunity. So seeing how these candles form, this right here is a bearish variation, which is, like, once again, I went over on some of my recent webinars. Right here, it does not say anything about sellers inside the market yet. Okay, sellers weren't established yet. So what you got to wait for? That next candle, which is going to be right here, which says that sellers are inside the market, which gives you enough volume to actually push to that next point of structure. Okay, so your entry point was right here. You could write it down. That could have been 40, 50, 60 pips. Who knows? You know what I'm saying? Depending on how you actually maintain your orders. Okay. In my 5-day course, sneak peek, my 5-day course, I said, like, whenever the market finds a level of support, okay, you measure it. If you're trying to maintain orders, you measure your level of support. If the market does actually break that 38.2 mark, okay, boom, close your order. Okay, that's being pretty conservative, but there's many ways on how to use Fibonacci and maintain orders. But remember, like, it's based off your risk factor. If you're risky like me, I would definitely, I would at times wait it out, because remember, I'm basing my structure off of the higher time frame. Okay, if you want to be conservative, a person would have got out on the 38.2 touch based off of the 30-minute time frame or the 15-minute time frame. Okay, so back to the time frame that I'm basing my overall move off of. So if I actually maintain my order, as far as kept in mind that my overall market that I'm measuring is based off the 4-hour time frame, my entries is once again based off right here, and I would have got out somewhere down this area right here. Because remember, so whenever you're using your fibs, the next projection for a downward push or for a continuation for that entire trend that you're always in, negative 27%, negative 27%, my bad, negative 27%, at the max, negative 61.8%, which is down here also. So you could have used your negative 27% for a TP, okay? If you wanted us to be just stick to straight technicals, if you wanted us to be a little bit, not too conservative, but a little bit risky. Fibs, once again, point A, point B, down here. Okay. And a person would have closed their order at that 38.2 break, at a 38.2 touch, as far as the respect. Okay. So you could have based it off of so many things, but you always have to keep in mind what time frame you're actually basing your structure on, and what level of a risk you're trying to actually take on that account. Okay, some people that they're a little bit risky but not too risky, they could have took their 38.2 based off of the H1 time frame. Okay, so once the market actually broke this 38.2 mark, a person that is a little bit risky but a little bit conservative would have closed their orders. If you're super conservative, then you would have closed your orders based off of the 38.2 retrace off of the 30-minute time frame. If you're trying to max it out like how I do, I'll base my retrace at times off the 4-hour time frame, the same time frame that I'm actually using my structure on. Okay, so at the same time, like, you gotta always keep in mind what actual structure you're actually measuring, what trend you're actually in. And if you're actually, if you're a conservative trader, risky, you got to always figure that part out also, because remember what I said, it's very subjective. Okay, it's very subjective. back on a 4-hour time frame. Okay. Again, this level of support was broken. The market found a new level of support down here. Okay. See like how this candle right here, it didn't create like a major wick like down here. That's called, that's more on the Meru Bozu side, which means that a lot of volume is in a downward push, which means that a lot of times it can be a continuation based off of that one candle. This right here is candlestick analysis. Okay. This right here shows like a valid, a valid pullback based off of that bearish candle, which can be your valid level of support for this push right here. Point A. Point B, at the bottom wick right here, and you're measuring that retrace. Okay. So keep in mind, guys. So you seeing this area right here being respected, it would have still been a valid sell opportunity based off of this time frame. Because remember, we're not seeing the future all too much. Okay, like we do technical analysis, which means that we're analyzing to pretty much help you predict the future of the market. Technical wise, that would have been considered as a lower high point. Okay, and it's respecting that 38.2 mark, which means that this right here is a tested area. Okay, so along this entire range. So me seeing how all this is forming and consolidating on that 30.2 mark, I would have been looking for potential setups based off the H1 time frame, which would have been valid when I seen this bearish variation right here in these 3 candles, which means that right here it says that sellers were inside the market, which means that more sellers were actually in the market to actually give you a push that could have helped you actually make profit. Seeing that we're expecting one thing, a lower low. We're at a lower high point right now, and what we're expecting right now is what? A lower low. Okay, so this right here said that sellers were inside the market. Yes, you would have seen drawdown. That's fine. You know what I'm saying? That shit happens. Whatever. Which means 10 pips fucking drawdown, which is nothing. Okay. Wait, let me locate this point. Entry point would have been somewhere over there, which means that your stop loss would have been where, guys? Either 110% or max 120%. So you have, options which determines like how much risk you plan on taking on your account. If you want to be conservative, get out at 110%. Set your stop loss at 110. If you want to max it out, set your stop loss at 120. Because remember, if the market did actually break this area, structure is broken, but also I don't want to be in the wrong direction. So that's my safety net to actually catch my order and save my account. Okay. And that's off of point A, point B, and that's the retrace, which is what I'm measuring to actually give me a selling opportunity somewhere over here. Remember, it respected 38.2 based off the 4-hour time frame, but on the 1-hour time frame, I could have seen a selling setup to actually guide me on the same direction that I'm actually measuring, because I never knew that this area was going to be broken structure based off of this area. Okay, that's where structure was broken. Okay, but at the end of the day, like me seeing this right here, I'm still going to be looking for a selling opportunity, because once again, I was in a seller's market. Okay, I was still in a seller's market. Okay, and let's throw some extra technicals in. This right here is a trend line based off your point A and your point B. The market actually broke into a buy zone. First retest, which is the first new higher low point after the fact, and also gives you your first buying opportunity on that retrace of that 38.2 mark also, which you've seen a bullish engulfing pattern at that 30.2 mark, which you're still looking for a push up, because once again structure was broken, and that's the first retest, which is going to be the first higher low point. Remember, no retest, no entry, and that's your retest area, which gives you a buying opportunity. So this right here is your bullish variation. Okay, so anything that is above this bullish candle right here, is a potential buy opportunity. Okay, so once this area forms, once this bullish candle or this bullish candle reverse pattern forms, anywhere above that area, I could look for a buying opportunity or a buy type setup based off the lower time frames, which give me a lot more details to actually enter on, which I could actually benefit on. Okay, so this right here is, what's the retest? Yeah, this is the retest area. So this right here, all of this together is a bullish engulfing pattern on a higher time frame, and anywhere along these areas in this green zone is a buying opportunity once you see a bullish type of move, which could have been right here. Okay, right here it came close, but it didn't actually close over this previous bearish open until the market actually closed over it on this bullish candle, which gave you that buying opportunity, which then you could actually broke down on lower time frames to get in on a more, it's all about precision at the end of the day also, on a more precise entry. You could have entered based off of the close of this bearish candle, this bullish candle right here, based off the 30-minute chart, or enter on the 15-minute chart. Or enter on the 15-minute chart right here. So this right here was your entry based off the 4-hour time frame, which is going to be, I'm going to put this one as yellow. This right here was a 4-hour, the 30-minute entry. And right here at the close of this candle on the 15-minute time frame could have been an entry off of the 15-minute chart. So as you can see, your entry is better based off the time frame that you actually enter on. Okay, it's a 4 pips better. Okay, it's definitely like, a good amount of pips that you can save if you do actually learn how to actually break the charts down and still keep in mind that you're basing your overall market off the higher time frame, and not losing track of where you are based off of your fibs and your structure of this time frame. Okay. So yeah. So this right here was the 30-minute entry. Not bad. Yeah, this right here was your 30-minute entry. This right here, this white line was the entry based off the 15-minute chart. So pretty significant, 4 pips, you could definitely be 4 pips more in profit, but yeah, so that's pretty much how I could pretty much take advantage of Fibonacci. Like I said, you always have to make sure that you're doing your fibs mainly on the time frames that you're actually doing your structure on. 4-hour chart, daily chart, weekly chart, and use those time frames for your overall market and your main fibs, and you can actually still analyze with your fibs on the lower time frames as well, but not lose track of where you actually are. Okay. So yeah. So this right here was Fibonacci 2.0. Fibonacci 2.0. Fibonacci 2.0. Actually, let me do this bigger. All right. So hopefully y'all enjoyed it. Hopefully y'all got some nuggets off of it. Yeah. So keep gaining knowledge. Keep being forever in profit, guys. And I'll see y'all on that next video. And my bad for making this video kind of long. When I start ranting, it happens. All right. So peace out, y'all.